Today we're going to discuss debt investments. So let's look at this example. Now keep in mind, when companies have excess cash, they decide to invest it so that they can receive a return. There are two primary categories of investment. One is debt investments and the other is equity investments. Debt investments are things like bonds, treasury bills, whereas equity investments are items such as stocks that are traded on the open market. Let's start with debt investments. Now when we talk about debt investments, so the company has excess cash, they go in and they actually take this and they'll invest in the bonds, for example, of another company. Now when they do this, there's three ways that we can classify these in our financial records. One is held to maturity, which simply means we plan to, as company management, they plan to actually hold these bonds until they actually mature. Then there is trading securities. Trading securities are simply held for very short-term changes or fluctuation in price, and our expectation is we'll hold it for a very short period of time and then we will sell it. Then there's available for sale, which is somewhere in between. We don't plan on selling it immediately. We've got it as an investment until we need it, but we definitely don't plan on holding it until maturity. We just really don't know when we're going to sell it. It doesn't fit in the trading security classification. It doesn't fit into held maturity, so we call that available for sale. So let's look at this example. Ladia VOG Corporation, which we're just going to call LV, acquired as a long-term investment $258 million of 5% bonds dated July 1st on July 1st, 2019. Company management has the positive intent and ability to hold the bonds until maturity, and that's what makes it an HTM, a held to maturity position. It's all about company's intent. What are they going to do with the security? Now it can change. They can sell it. They don't have to hold it to maturity, but that's their expectations at this point in time. The market interest rate yield was 12% for bonds of similar risk and maturity. So notice there's two rates that are associated with bonds. We've got the 5% rate, that's known as the stated rate. That's the amount of cash the bond will pay every year regardless of the market rate. The market, also known as the effective rate, is 12%. Now think of it from an investor standpoint. If you've got two companies that are similar in risk, they have the same really makeup, so to speak, they're going to mature at about the same point in time. Would you prefer a 5% rate or a 12% rate? Well, from the investor standpoint, you want the higher rate. So you're really going to want to go for the 12% if everything else is pretty much equal. So that's the problem with our bonds. In this case, we're not going to pay the full face value for the bond simply because those two rates are not the same. Okay? So let's continue on. LV paid $215 million for the bonds. There we go. You see, since the market rate is 12%, our bonds only pay 5%. They're not going to pay $258 million. They're going to pay a discounted amount, so that the net between what they pay, the $215, and the 5% annual payment will equal a 12% rate of return for this bond. So it all balances out. Now our bonds are equal with those in the market. The company will receive interest semi-annually on June 30th and December 31st. So in other words, we pay 5% per year. We only pay 2.5% then every 6 months. As a result of changing market conditions, the fair value of the bonds at December 31st was $218 million. So let's start here at the beginning. How would we record these on July 1st when we actually purchase the bonds? So let's go in and do July 1st. Now, first thing we have to realize is that we need to actually go in and put the investment. We're investing in these bonds. We're not issuing them. So we're going to do investment in bonds on our books. Now we're always going to carry this investment at, well, let me rephrase. We're going to record the investment account. This actual account will always be at face value, the $258 million. And we're going to record everything in millions. So I'm just going to say 258 from here on out. Now, what else has to happen? Well, we know we have to pay cash out. Cash has got to be decreased, so that's a credit to our cash of $215. Now, where's the difference going to go? Well, notice that creates a $43 difference between our debits and our credits. That is known as the discount on the bond. So we're going to go in and we're going to say a discount on bond investment. Now that discount will be amortized over the life of the bond. In other words, every time an interest payment occurs, a little bit of that discount will be amortized. What that will allow us to do is put the interest revenue at the 12% mark, so to speak, whereas the cash that we receive will be at the 5%. All right, so let's move on and look, how would we record the interest? So number 2, prepare the journal by LV to record interest on December 31st, 2019 at the effective market rate. So to do that, we're going to go in, first off, December 31st. Now, again, when the bond pays interest, our company will receive cash. Now, to figure out the cash amount on a bond, there's a quick little formula. We always take the face value of the bond times the stated rate of the bond times time. So again, the face value on this bond, and we'll put it right here, is $258 million. We're going to multiply that 258 by the stated rate, which was 0.05 or 5% times time. Now, the way a bond works is it will be 6/12 every single time we have an interest payment, unless, of course, you cross a year in. Notice that every 6 months they're going to pay half of a rate. So really the easiest way to do it would be 258 times 2.5%, half of that percentage. But I like to see the full formula every time so you can see it. Now, when you multiply that out, you should get 6.45. That's the amount of cash we're going to receive from our the company, we have invested in. So now, what are we going to credit? Well, this is going to be interest revenue. Now, you will see some books call it investment revenue. I prefer to call it interest simply because bonds pay interest. So we're going to go ahead and put interest revenue. Now, to calculate the interest revenue, we're going to use what we call the effective interest method. And what we're going to do is we're going to take the carry value of the bond, we're going to multiply that by the effective rate, also known as the market rate, times time. Now, the carry value of the bond is always the value of the bond on our balance sheet, which is simply the investment and bond account netted with its associated discount or premium if this bond had been sold at a premium or purchased at a premium, So at this point in time, our carry value is 215 because notice our investment in bond here has 258, our discount has 43. We have a debit and a credit, so those are going to net down to the 215. So we're going to take that 215, we're going to multiply it by, again, the effective rate, the rate that this bond is supposed to yield, and that's going to be a nice 12%, and then we're going to multiply that by 6/12 again. Since this is a 6-month bond, that's half a rate, so you could just take 215 times 6%. When you multiply that out, you're going to end up with 12.9. Now notice we have a little bit of a difference here. What's that? Well, remember we said the discount is going to be amortized a little bit every single period over the life of the bond. So we're going to simply amortize or reduce the discount on bond investment each interest payment, and it's whatever the difference is to fit. And again here, it just happens to also be 6.5. Now, the cool thing about bonds, whether it is a trading security available for sale or like this one, a held to maturity, the actual purchase and the interest recording is always the same. The type of bond doesn't impact those two entries. What it does impact is our year end that we have to look at, and possibly when we sell the bond. All right, so third question here, at what amount will LV report its investment in the December 31st balance sheet? Well, our bonds are going to be carried, our investment bonds are going to be carried at what we call carry value or amortized cost if it's a held to maturity. So since this is an HTM, we always carry those at the carry the bond at the amortized cost of the bond, which again is simply, in this case, it's going to be the investment and bond account netted with the discount. So at this point, we just have to look and see, well, how much do we have in that account? Well, again, the bond account has 258 in it. Now we're going to net that, and since it's a discount, it's going to be a reduction. Now we started with a balance of 43 in the actual discount, but remember we amortized 6.45 of that, so that's going to reduce that balance. So that's going to leave us with the carry value of 221.45. Well, and again, these are in millions, so make sure you note that. And that would be the carry value. That's what our bond would be reported at on the balance sheet. All right, so this is a held to maturity. We do not care about the fair value. So notice it says that the fair value of the bonds at December 31st was 218. And at HTM that doesn't matter because we carry them at amortized cost. So that it's going to be reported at 221 regardless of fair value. Now, January 2nd of 2020, which is the next year, right after we recorded that interest, basically, the first business day here, Moody's bond rating agency downgraded the risk rating of the bonds. So in other words, the company's worse off. We're not quite as good a position. So we decide as a company to sell these. Again, it doesn't matter that it's HTML. We can sell them at any point in time, even though we had intended to hold them to maturity. So here, LV decides to sell the investment on January 2nd for $191 million. Prepare the journal entry to record the sale. All right, so we're going to go in and we are going to, first off, record the cash payment that we're going to receive. So when we sell the bond, we're going to receive cash, and that's going to be $191 million. Okay. Now there's a few things that goes on with this. If you want to think of it logically, when we sell the bond off, we have to get rid of all the components we put on for the bond, except for the interest revenue. So notice when we put the bond on, we put the investment and the discount. So when we take it off, if there's any discount left, we have to remove both pieces of that, just like getting rid of any asset. So one, I know I have to get rid of my investment in bonds, and that again was carried at face, so 258. And also notice we still have this nice little discount account here. It has a credit balance, not 43 because we netted with the 6, but it has a credit balance. So to get rid of that, we need to go in and debit the discount on bond investment. Okay. Now, how much is that? Well, again, we had the 43, but we reduced it by 6.45. So if you want to put in here 43 minus 6.45. And what that gives us is actually 36.55. And to make this look a little better, I'm going to even that up just so you can see. So now you have that removed. So what's left? Well, we're carrying this bond basically at this point at 221.45. So if you have an asset valued at 221.45 and you're selling it for 191, what's going to happen? Well, you're either going to recognize a gain or loss in this situation. So what are we going to do? Well, obviously we sold it for much less than we're carrying it at, so we're going to take a loss on investment. We're going to go in and hit that loss on investment for whatever amount we have lost. Again, it's the difference between the 221.45 and the 91, which comes out to 30.45. So that's just a little bit about how you actually account for a bond held to maturity.